The CPI numbers came out yesterday, 8.3%, stunned the world. I'm going to do a deep dive into it and how it directly affects the housing market. Hi, this is Troy, and I have several different articles today and graphs on the CPI numbers from top analysts to show you how this is affecting your everyday life and how it's affecting the housing market. Welcome everyone to Real Estate Daily with the House Heroes. Every day we go over the latest in housing, real estate, as well as the mortgage markets. Now, before we jump into this, hit that like button, smash that like button, and also hit that subscribe button. We're growing this channel, but we want to continue to get the word out to everybody. Let's jump into it. This is a Twitter thread from Charlie Bilello. He's one of the top analysts at Compound, and this is a CPI report year over year. What we paid on average in the United States year over year for these different categories. Let's jump into it. Fuel prices. This is kind of ridiculous. Let's start this off. We've gone up 68%, 69% in fuel alone. Gas utilities up 33%, gasoline 25%, electricity up 16%. How is everyone feeling comfortable with this? How is the federal government feeling comfortable with this? This is year over year. Food at home, 13.5%. Transportation, 11%. New cars up 10% year over year. Overall CPI, which we talked about, 8.3%. Food away from home, 8%. Used cars, 8%. Shelter, 6.2%. And we know those numbers are way off. And then Medicare or medical care, 5.6%. So now let's go do a deep dive into the graph. All right, so this is US monthly rent. This is a national average, and this is by apartment lists, okay? Now the data, if you look at it from December 20th all the way to August 22nd, even in the last 12 months, year over year, we're seeing a 10% rise just in monthly rent. Now, we all know that in certain cities, and this number is absolutely suppressed, there is no ifs, ands, or buts. In certain cities across the United States, and we had this conversation before, such as Los Angeles, the city of Los Angeles, city of Minneapolis, and other cities, they have had a rent freeze going on. It is very important. Anyone out there that's looking to invest, they need to know where they're going to invest at. It's so important. And then how to invest. I know I get asked all the time, Troy, I got this money set aside. I want to buy a rental property. I want to buy a duplex, a fourplex. And I say the very first place you want to look at is the city you're going to be in. What are the restrictions in those cities? And then what is that growth in those cities? How are they growing? Before I look at the property, before I look at properties in that area, it's extremely important to know that information. And we're seeing that national average of rents are going up by 10%. But if your area is rent control or rent restrictive, meaning that you can only raise it 2 or 3% a year, even year over year at 10%, you couldn't even raise it 10%. So it really matters. Number one, as an investor, as myself, I am an investor as well. I am caught up in all the political rhetoric that's going on in certain cities. And if I knew this was going to happen, if I had the foresight years, a decade in advance that I knew that the future was going to be like this, I wouldn't have invested in those cities. I would have actually sold way before now. Next graph. Now, this is the Case-Shiller U.S. National Home Price Index. And this is somewhat of how the federal government kind of looks at shelter. Now, we know that shelter, which is rents as well as home prices, are 33% of the CPI number. It makes up the most. Now, it had gone up from 5.6 to 6.2 year, from month over month, from July to August. But we obviously know it's significantly higher than that. And these numbers are being suppressed by the federal government. How are they suppressing them? Number one, they're not taking real data. They're taking surveys. And this is what doesn't make sense. You have real data out there. You can go to the NAR, National Association of Realtors. You can go to apartments.com. The places where people, or even Zillow numbers, just take Zillow numbers and you can do some kind of formula and put it together, but they don't. They take surveys. And if you were to survey rents in the city of Los Angeles, the rents were at 0. And if you surveyed them, I should say raising rents or rents going up were at 0% year over year. If you were looking at month over month rents in New York City, same exact thing. But if you were to go outside of that, let's say in Anaheim, in Orange County here, you would see rents going up 15%. And so when you take that average of 0 and then 15%, well, it comes in at 7.5. Well, one is restricted by the government, so it's being manipulated. Others are not. They're simply the market itself. Well, here's the Case-Shiller U.S. National Home Price Index year over year. Now, they do this once a year to take a snapshot. The last time they did it was less than a year ago, and it showed 18%. Now, the National Association of Realtors have come out and they do it every month, but they're trailing usually 45 to 60 days. Last one I saw, they showed year over year nationwide, we're approximately 15 to 16%, right in there. So it still doesn't really make sense how we're still getting shelter at 6.2%. I think that number is really much more higher than it is. But I wanted to show you, if I'm out there and I'm looking for a home, I'm looking at price appreciation on a house, and then I'm looking at rents, what am I actually seeing? If I would have bought a house a year ago, okay, I would have seen an appreciation of that price on an average about 15% year over year. So a year later, I would have shown a 15% equity position on an average. Now, if I were to have rented a year ago and my rent contract was up, my 1-year lease was up, I was going to see a 10% increase. This is the point that I'm trying to make. If I'm looking at rents going up every single year at 10%, or even at, let's just take a more realistic view of 3 or 4%, but I bought a home in which I have a stable and locked interest rate, I'm going to see that regardless, it's deflationary. It doesn't matter if inflation goes up. My mortgage payment will stay the same. It's very important to understand that. Now, I say this because if you look at some of those are 30-year fixed rates that you're usually seeing. Some people have the benefit of 15-year fixed rates, but now when they're introducing 40 and 50-year rates, programs, those are going to be fixed for all those times. You're going to see in those 30 or 40 years, your house, and this is not financial advice, and this is absolutely, if you look at a 30-year map, you're going to see prices of your home double. It doesn't matter if it went down a couple years and then it shot back up. There's just not enough homes for the population that's out there, and that's why we're seeing homeless go up, right? We're just not seeing, we're seeing that. So with that being said, these are very important graphs by Charlie Bilello of Compound. He's putting this out, and I like to go over these in our daily, real estate daily, because these are important numbers that we want to see to understand why. If I had an opportunity to buy a house, I should be buying a house. If I bought a house a year ago, I have, at least on my shelter, I've made this deflationary or at least not inflationary, right? All right. So we know yesterday's CPI numbers were up 8.3%, and the stock market took a dump. Crypto took a smaller dump. What did the interest rates do? Well, I had said this before. I said that the market had priced in the interest rate hikes that the Fed had done now for the past. And so many people out there, including the media, which I really hate the media because it manipulates everyone's mind. They said, oh, well, now, unemployment's starting to tick up and, inflation's coming down. We're going to reverse everything. We're going to either not raise rates or we're even going to go and lower rates. And you know what? Even some crazy people out there said, we're going to turn the printers back on. You know, it's not realistic. It was never realistic. And yesterday proved that point. This is what happened in the market. 30-year conforming which is conventional. It just rolled right past 6%. The largest jump in 20 years. Actually, we're over 6%, which was 20 years ago, right? We got to know that this is going to happen. And we're going to see that this hopefully is priced in when the Fed meets at the end of this month, because I personally think that there is a 75 basis point raise that's going to happen. I've said that from minute one. I've seen it all started at 25%. As of yesterday, it was at 19%. That was the Vegas odds, let's call it, right? On a 100 or 1 basis point raise. Today, it's at 36. So it went from 19 to 36 on 1 basis point. If we see 1 basis point, we're going to see a very big shock to our system, and it's absolutely going to hurt. You know, it's going to hurt everything. It's going to, if you have money in the stock market, if you have retirement funds, they're all going to get crushed. If you're a crypto maniac, you're going to short the market. You better short the market because it's going to hurt. 75 basis points are going to hurt already, but look at these numbers across the board yesterday. We're looking at, 13% jump in 15-year, conforming conventional. Jumbo has been, like I told you, on a big volatile rise. It's up 14 basis points. FHA took the least amount of hit. It's only up 6.5 yesterday. It's the market is bracing for itself. I think that the only good thing is that a lot of mortgage companies will pivot into 40-year mortgages and try to keep that rate down. But if they don't, 30-year mortgages are becoming a little pricey right now. And if they keep going up, if we keep seeing a 75 basis points rise in this month, now the Fed will not meet in October, but they'll meet again in November. I still see another 75 basis points in November. I don't think we're even close to where they need to be. The Fed has said 2%. So if I was on the sideline and I had an approval letter in my hand, okay, I would be looking at a home. Now, a lot of people out there go, Troy, you're just a homie, for real estate. But I'll tell you this, and I've said this before, and I said it 15 years ago and 12 years ago and 10 years ago. When you look at rates going up and housing prices going down, the mortgage companies makes it almost impossible to get approved. That little 90-day approval letter means nothing. They will change the guidelines on you today, and you no longer are approved. You have to know that. And if you don't know that, you'll be shocked and you will continue to be a renter. That is my little 2 cents and my opinion piece for this segment. Please understand it. Guys, I know I rolled right past the 10-minute mark here. My producer just threw stuff at me and hit me inside of the head. Either way, you guys have a fantastic day. I will see you tomorrow. Welcome to Real Estate Daily.